I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Intel CEO Pat Gelsinger tells us more about his plan to invest $20 billion to build new factories to make its own chips and chips ordered by companies like Apple, or so he hopes. What he has to say to analysts who think he's in just a, quote, honeymoon phase. We'll hear from him and a tech investor this hour. Plus, misinformation at the center of Thursday's hearings on Capitol Hill. Zuckerberg, Pichai, Dorsey, all in the hot seat. But will it do any good, or is it a colossal waste of Congress's time? We'll discuss. And buy a Tesla with Bitcoin. Elon Musk tweets you can do that now. Wedbush calling it a seminal moment for both the company and the currency. All those stories in a moment, but first, U.S. stocks slumping with tech leading the declines as investors rotated out of stocks that have been thriving through the pandemic. Let's get a check on things with Bloomberg's Kriti Gupta and Ed Ledlow. Kriti, we'll start with you.
Well, let's just talk about the tech underperformance, because this has been a stark contrast to yesterday. Take a look at the chart behind me. Of course, you see, well, first off, we should mention that this is, of course, guiding ahead of those big tech hearings tomorrow. But now let's take a look at the chart behind me, really just seeing a lot of that tech underperformance. And this, of course, is coming in tandem with yields coming down as well. Now, Emily, we know that tech and yield have been moving in opposite directions. So when you have those surging yields, you tend to see tech underperform. Today, they moved in the same direction. But let me just graph this for you. Let me show you that correlation where you can really see that relationship, the idea that when you have things like the TIPS yield increase, you do see the NASDAQ 100 sell off. This, of course, is also an interesting chart to look at. The dollar's drop helping precious metals sparkle, this idea that the dollar has actually underperformed. So it really does tell you that when you do start to see moves like that, it does trade into the commodity space. But I really want to bring it back to tech. We really have this idea that this tech trade isn't just here in the States. It really is a global phenomenon. You saw it in Chinese ETFs. You also saw it in things like momentum trades, that ARK Innovation ETF, a very crucial thing to keep your eye on. When you see tech sell off in the U.S., you tend to see it happen globally, and that was really the case today. For more of the price action, though, I want to go to Ed Ludlow.
Yeah, there's no escaping the tech hearings, and I'm not necessarily drawing a causal link, but we did get written testimony, and those stocks are under pressure. You see Facebook down almost 3%, Twitter down 3.4%, and actually, Alphabet shares, Google parent, had been higher for most of Wednesday and then fell away towards the close. At issue is how do you moderate content? Section 230 of the Communications Decency Act shields those tech companies from any liability for content posted to their sites. The question for investors is, why do we care? Is there any fundamental change to those laws proposed in tomorrow's hearing or by future regulation that would impact the top or bottom line? If you read Bloomberg Intelligence today, the answer is no. It's interesting if we flip up the board to see how those different shares have performed since the election, because that's where this all started. Twitter, clearly the outperformer since November time, right? And you see Facebook lagging down there, Alphabet shares somewhere in the middle. The volatility that we saw around the election was relatively muted, but Facebook and Twitter were under pressure because there was concern that content moderation, or at least the sharing of misinformation on those platforms, might impact the company, might impact the stock. So definitely one to watch on Thursday. A story we can't escape, Emily, Intel. I just want to touch on it very briefly because the euphoria that we had in the last 24 hours over this new Intel plan has definitely faded away. The stock closing down 2.3%. Under pressure, investors taking a moment, thinking about it, and despite those bold capex plans, it's going to take time to implement. TSMC is going to keep its lead in the foundry business for the time being. That's the message from Wall Street. One of the best performers of the S&P 500, though, Applied Materials. Why? Because they are boosting capex. Intel is boosting capex this year to $19 to $20 billion. Where's it going to spend it? The company that builds the machines that makes the chips. That's what you need in a new factory. Flip up the charts really quickly because it has been an amazing 24 hours. We got this incredible spike. Lots of positivity, lots of enthusiasm about the Intel news. By close of play on Wednesday, we'd lost all our enthusiasm. Maybe we'll hear about why from the CEO, Emily.
All right, Ed Ludlow, Kriti Gupta, thanks so much. Let's hear what Pat Gelsinger has to say about some of that. Pat Gelsinger, the CEO of Intel, unveiling plans for U.S. manufacturing revival with billions of dollars to be spent on new factories and a new foundry business that'll make chips for other companies. Earlier, I spoke with him about why he's changing something that has been so fundamental to Intel's previous strategy, which is building chips on its own designs. Take a listen.
The core IDM 2.0, integrated design manufacturing version 2, as I call it, says, hey, we're going to manufacture the majority internal, continue to build on that great heritage, but also leverage external foundry in a more strategic way. And there's a big shift in the industry underway from system on chip to system on package. And really our ability to leverage the world's best 3D packaging technology so that we get to pick the best tiles from across the industry. And third, to become a foundry. Those three taken together form this IDM 2.0 because I'm committed to the best products in every category that we participate in, the best cost structure, and the most resilient supply chain. And we see this ability to leverage the industry, but also become a major supplier of foundry to the industry. This is a winning formula, and the world is demanding more semiconductors than ever before. We were getting more digital, and then COVID happened, right? And it's accelerated. So we need to step into this in a big way. And I think our strategy is uniquely positioned for Intel to be able to execute on.
Now, investors loved hearing you say Intel's fixed all its problems. But Pat, you've been back at the company for just over a month, and we're talking about production deadlines that were missed over years. What makes you so sure that you've diagnosed and solved the manufacturing problems?
Looked at the data quite extensively over the last month or so and came to the conclusion, yeah, the team got it figured out. We're back. And as you've seen more broadly with our new Intel IDM 2.0 strategy, as I've declared, Intel is back.
Now, you suggested companies like Apple and Qualcomm could be your customers. Why would they be your customers if they are your competitors? Why should a fierce rival also work with you?
Well, as you well know, Emily, and I think you've even written on the subject about co-opetition. And clearly this idea that, in some domains you might compete, in other domains you might be competitors, customers and partners as well. And for that, there's very few companies that can step into advanced semiconductor technology, something that we've only used for our internal needs at scale before. But now we're saying we're going to open our fab doors wide for the industry. And with that in mind, customers are looking and saying, I only have TSMC, Samsung, and Intel as the leading choices, and only one of those is on Western US and European soil at scale. Wow, I need a more balanced supply chain. I want to have at least two suppliers of my advanced technology choices. And Intel is saying we're going to be that.
What are the financial implications of the move? You're obviously raising your capital spend by $6 billion. When does this all start paying off?
Well, it is a capital-intensive cycle. Takes a couple of years to build fabs, so you invest well before you have that foundry capability up and running at scale. That said, we are seeing extraordinary demand signals from the industry for today's products. So part of this is I get to flexibly build capacity that meets my products as well as foundry needs. And we expect that we'll run a factory network that has some optimized for our products, some optimized for foundry, and some flex fabs in between, because we need to be at scale across the business. But we do think it takes a couple of years to build this out, as designs take time to be committed to a new process and then test and ramping in manufacturing. But we're underway. We already have some existing foundry customers at small scale that will start ramping up more rapidly. So this business will get underway. We've estimated the overall foundry market at $100 billion by 2025, and we're going to earnestly pursue a meaningful portion of that.
What does this all mean for the chip shortage, which has been so devastating to the industry at a time when chips are desperately needed? When will the chip shortage end?
Yeah, it's a great question, Emily. And the first thing would be is how do we get here? Because we were on this path to more digitization of humanity, and then COVID happened. And what we saw was this, COVID caused everybody to step back a bit from capacity and build out and the supply chain of the industry, and it induced a radical increase in demand. So you have supply chains scaling back a bit and demand scaling up radically. Wow. And now we're in a position that there's a meaningful shortage. And, it's going to be a couple of years until that's fully resolved, is my expectation. We, in our announcements yesterday, are saying we're going to start helping on that as quickly as possible.
Now, Pat, U.S. politicians, the Biden administration, even the Trump administration had been quite alarmed about the decline of chip-making capabilities in the United States. What does this mean for U.S. competitiveness in chip making? And have you gotten a reaction from the Biden administration to your plans to double down on manufacturing in the United States?
Yeah, there's been a real outpouring of support, not just from customers in the industry, but from the administrations in the U.S. as well as the EU. So there's great interest in what we announced yesterday. Late last year, the CHIP Act was passed. Now it needs to be funded. Yesterday's statement, though, from Intel, we put our chips on the table. We're making these investments and commitments without a penny of funding from governments or states. However, we believe that they can be meaningfully accelerated and expanded by seeing increased commitments by governments in U.S. and Europe. So we're doing our part, and we hope to scale that up dramatically with strong support from the administration.
My conversation there with Intel CEO Pat Gelsinger. You can check out the full conversation at Bloomberg.com. Coming up, expect Intel's ambitious plan to spark capital spend across chip makers, not just Intel, so says Dan Morgan of Synovus. We'll speak to him next. This is Bloomberg. We just heard from Intel CEO Pat Gelsinger earlier, laying out his plan to double down on chip production in the United States and also make chips for other companies based on their designs. In his ideal scenario, companies like Apple and Qualcomm would be customers. Intel shares rallied after Gelsinger revealed this big revival, but fell flat today. With me for more, Dan Morgan, Trust Portfolio Senior Manager at Synovus, who says Intel's $20 billion plan may be just the start of something bigger for the chip industry overall. And Dan, you have a huge holding in Intel, more than 550,000 shares. So what's your take? Is it a good move? And can Gelsinger deliver?
Well, Emily, it's huge news. I mean, $20 billion to build 2 plants in Arizona. And as you were talking about before I came on, Intel, we know of them as a big producer in terms of chips that go into PCs. We know they're a major player in terms of chips that go into servers, that go into data centers like AWS and Acer. But now they're talking about building out capacity to the point where they can start producing chips for other companies who do the design work and producing the actual chip, kind of like a Taiwan Semiconductor or Samsung. That's what they do. They produce chips for NVIDIA, for all the big chip producers, because most of the chip producers, as you know, Emily, are called fabless, which is they're very good at design and marketing, but they actually produce their chip through another foundry like TSMC. And it sounds like Intel wants to get in that game, and that's going to be really interesting.
Now, it was interesting to watch the movement of the shares. We saw shares spiking after hours as Gelsinger was laying out this plan yesterday, then closing down today overall and erasing those gains. I spoke to an analyst who said this is the quote-unquote honeymoon phase, and that will be short-lived. Investors want to be optimistic, but these changes are going to take place over a long time if they happen. I asked Gelsinger to react to that idea that he's in a honeymoon phase. Take a listen to what he had to say.
Well, I do think there's been a bit of skepticism, and we've had the bulls and the bears around the stock. We've also had some fast money going through the shares and trying to figure out what it's going to look like. I'm interested in long-term investors that are committed to the strategy that we're laying out.
Dan, it's one thing to say Intel is back and, we can do this. We're back in the ring. We want to be competitive. And it's another to actually execute. What's your response to that?
You're right, Emily. And, you talked earlier about the production glitches that they had. A lot of those issues led to them losing market share, especially in the PC space, to AMD. The other question is, like you say, can they deliver? This is a big change. I mean, Emily, I've been at this a really long time. I actually remember when Intel produced memory chips. This is like before, like like before the 1990s, and competed against companies like Micron Technology. So, can they execute? And I think that's what you're talking about, this honeymoon or this skepticism, and that is, can they execute becoming a foundry producer, not just a company that's going to produce chips for servers and for PCs? And I think that's really where the doubts came in. I know we saw good trading today in the equipment manufacturers, AMAT, KLAC Tencor, ASM Lithography, and Lam Research. So they all did well. They're going to benefit because they're selling the equipment, right? But there is some skepticism whether Intel can execute.
Curious what your thoughts on the chip shortage are, because Gelsinger told me he thinks it's going to take a couple of years to resolve. But when we spoke with the CEO of Qualcomm, Cristiano Amon, incoming CEO of Qualcomm, he thinks it's going to be resolved by the end of the year. What do you make of those conflicting interpretations?
I would agree with the CEO from Qualcomm, and that is that based on what I'm seeing, Emily, I think pretty much by the second half of this year, probably fourth quarter, a lot of those are going to work through. You have to remember that we went through the pandemic. They shut down the auto manufacturers, as you've talked about. So a lot of the chip producers went over to producing chips for things that were helping people in the work from home, the pandemic-oriented type of things. And then all of a sudden, auto manufacturing ramped back up again, and there were no chips. So I think that's starting to even out. I've even seen some comments coming out from some of the auto manufacturers that things are getting better. So I think a lot of the people who have ordered ahead, which causes a lot of the shortages because they're worried about inventory, they're starting to get a little more comfortable. So I think by the second half of this year, I think things should start to work out, and these shortages won't be such a big issue as they have been in the last 12 months.
So you see Intel's big capital investments proliferating at other chip companies, chip competitors. How do you expect this to play out? I mean, what do you see the response of a TSMC or a Samsung or even a Qualcomm being? And will a Qualcomm want to have Intel make its chips?
Well, yeah, I mean, so the CEO brought up some interesting points. So you have Qualcomm, you have Apple, right? You have Amazon's even talking about coming out with their own chips, right? They go into their AWS servers. So the idea is even Google has their own Tensor unit, and they make chips. They have an agreement now with Broadcom. But will those companies then take those designs and give them over to Intel? And how is Taiwan Semiconductor and Samsung responding? Well, Taiwan Semiconductor just came out and said we're going to spend like $28 billion in capex next year, more than the $20 billion that Intel talked about. And I believe Samsung is at about $118 billion over the next 10 years. So they're responding by adding capacity also. But now you're going to get some fierce wars, right, Emily, between Intel, TSMC, and Samsung to be able to produce these highly specialized chips that come from like Apple, Amazon, Qualcomm, NVIDIA, all these companies that we talk about.
Curious what your thoughts are on the broader rotation out of tech. We're in this sort of middle period where, we still need tech to, continue to work remotely, but people are starting to go back to the office. Vaccines are rolling out. We're seeing investors dump some of the tech names that have been thriving. Is that a momentary blip, or do you see longer-term rotation out of tech stocks? And are you planning to rotate out of tech as we move into a new normal?
Well, Emily, I don't believe so. I mean, I think the tech fundamentals are still in place. I mean, you look at the IT budget expectations came out from Gartner. We're looking for 6.2% growth. We expect the software group to continue to do well. We talk about the chip sector really executing on all cylinders at this point in time. So I think it's more of just, we had this huge run up. We talked about this before. In terms of the SOX is up 130% from a year ago. The S&P Information Technology Index is up 90%. So we've had this huge jump, and the overall benchmark is right now at about 35 times earnings. The S&P Information Technology benchmark is not huge compared to 70 back in 2000. So I just think you're seeing some natural profit taking on good news, money rolling out, but the fundamentals are still very strong. We had Adobe report numbers last night. in the cloud space. Great numbers. We had CrowdStrike last week. They had great numbers. So really, there's no fundamental breakdown in the group. I think it's just money naturally rotating into more cyclical groups and getting away from the huge run-up that we've had. But I don't see anything, Emily, like we saw back in the summer of 2000.
All right. Dan Morgan, Senior Trust Portfolio Manager at Synovus. Dan, always appreciate your thoughts here. Looking forward to watching the chip wars play out. All right, coming up, Elon Musk doubling down on Bitcoin. Tesla will now accept the cryptocurrency as a form of payment for its electric cars. We'll have more on that next. And as we head to break, you can see Bitcoin prices jumping on that Tesla news this morning. Look at that chart there. This token has fluctuated wildly after hitting a record of more than $61,000 about 10 days ago. We'll continue to watch how it moves. More next. This is Bloomberg. Some tech stories we're watching. Tesla going all in on Bitcoin. It stunned the market last month with a $1.5 billion investment from the world's largest cryptocurrency. Now, CEO Elon Musk says you can buy one of his electric cars with Bitcoin itself. Musk also saying any Bitcoin paid to Tesla will not be converted to a traditional currency, but will be held as Bitcoin. GameStop is hoping to bounce back from disappointing earnings in the fourth quarter. The video game retailer wanting to make good on a comeback plan that has helped turn it into the year's hottest and perhaps most controversial stock. GameStop has appointed a trio of executives with tech experience. They'll be a big part of a plan to make the company an e-commerce powerhouse. And private equity firm KKR and music company BMG Rights Management are teaming up to acquire song catalogs. This following blockbuster deals by artists like Bob Dylan, Stevie Nicks, Neil Young. The two firms will search for deals together and can invest as each side sees fit. The value of music rights has soared recently, in part due to the growth of streaming services. Dylan sold his catalog to Universal Music for more than $300 million. And coming up, misinformation run rampant. We are taking a look at what we can expect from the CEOs of Facebook, Twitter, and Google as they get grilled in yet another tech hearing on Capitol Hill Thursday. And later, why single women are avoiding buying homes in America's tech hubs and what cities they're flocking to instead. That is ahead. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. In what is becoming a familiar scene, tech CEOs will appear virtually in front of lawmakers Thursday. Here's a rundown on what the hearings are expected to cover and those in the hot seat.
Another tech hearing is on the horizon. This week, the CEOs of Alphabet, Facebook, and Twitter will once again testify virtually on Capitol Hill as Washington continues to crack down on big tech's power. The House Committee on Energy and Commerce saying this hearing will continue the committee's work of holding online platforms accountable for the growing rise of misinformation and disinformation. This after a year of falsehoods from COVID-19 to vaccines and, of course, the presidential election running rampant online. While tech platforms have implemented policy after policy to curb the spread, some lawmakers have claimed it's more censorship than moderation.
Who the hell elected you and put you in charge of what the media are allowed to report and what the American people are allowed to hear?
We realize we need to earn trust more. We realize that more accountability is needed to show our intentions and to show the outcomes.
In addition to misinformation, Section 230 is also bound to come up.
Section 230 is the most important law protecting internet speech. And removing Section 230 will remove speech from the internet.
We have heard resoundingly from our community that people do not want to see misinformation and believe that it is a problem. But people also believe that they do not want Facebook to be the arbiter of truth and deciding everything that is true and false.
Google is deeply conscious of both the opportunities and risks the internet creates. We feel a deep responsibility to keep the people who use our products safe and secure.
Still, the chair of the House Antitrust Subcommittee, Democratic Congressman David Cicilline, says a major reckoning is in order.
These companies as they exist today have monopoly power. Some need to be broken up, all need to be properly regulated and held accountable.
It's the first major congressional antitrust investigation by Congress in 50 years, and Thursday's hearing on big tech's staggering influence certainly won't be the last.
We've gotten the prepared testimony from Zuckerberg, Pichai, and Dorsey for the hearing coming up in 24 hours. Among the quotes that caught my eye, Mark Zuckerberg saying, quote, instead of being granted immunity, platforms should be required to demonstrate that they have systems in place for identifying unlawful content and removing it. Here to help us figure out what to watch at the hearing is Associate Professor at UCLA and best-selling author of Algorithms of Oppression, How Search Engines Reinforce Racism, Safiya Noble. Safiya, thank you so much for joining us. It's great to have you back here on the show. I want to start out with Facebook early investor turned critic Roger McNamee, who says this hearing may all be just a waste of time. In a recent op-ed, he says, quote, if past testimony is any guide, the CEOs will dissemble and promise to follow up with better answers to any question they do not want to answer in front of the cameras. Nothing will change. What's your reaction to that, Safiya?
Well, I think Roger is a formidable critic and knows from the inside out as an early investor in Facebook what he's talking about. I've had a chance to review the testimony too, and it's I think it is a little bit of a business as usual position that each of the companies is taking, which is to somehow get ahead of the reforms that they know are in fact coming from Congress and potentially other agencies, and to articulate the terms of the debate around the reform, for example, of Section 230. So I think what we want to watch is to see what specifically it is that they're calling for, and that will tell you that they are indeed trying to position and frame any kind of legislative changes in their own interests.
So let's talk about what they're calling for with regard to Section 230 in particular. Mark Zuckerberg is calling for reforms, but also says if content isn't caught by their content moderation systems, they shouldn't be held accountable. Sundar Pichai is cautioning against any reforms at all. Pulling from his testimony, he says regulation has an important role to play in ensuring that we protect what is great about the open internet. We are, however, concerned that many recent proposals to change Section 230, including calls to repeal it altogether, wouldn't serve that objective well. And then you have Jack Dorsey, who actually doesn't mention Section 230 at all, but has indicated in the past he is open to some changes. He says, we recognize that addressing harms associated with misinformation requires innovative solutions. Content moderation is in isolation not scalable, and simply removing content fails to meet the challenges of the modern internet. What do you make of their different approaches here?
Well, obviously, each of these companies occupies a different kind of, let's say, monopoly status in the internet and kind of big tech sector. Facebook and Google, or Alphabet in particular. I think it's interesting that the kind of proposition here, let's take them one at a time. Facebook, for example, saying if we demonstrate that we tried, that should be good enough. That's actually the headline of Mark Zuckerberg's testimony, and that if we provide evidence that we are indeed employing content moderators and software and reporting to law enforcement, well, they already do these things, and we see what a failure there is in their systems. So they're actually calling for the status quo, to do the bare minimum, which is what they're already doing. I think in the case of Google, it's interesting because, they're also really, I think, facing the antitrust kind of monopoly challenges now. And so their problems are, quite frankly, bigger than Section 230. And of course, none of the three platforms are interested in having to take responsibility for the kinds of content that moves through their platforms, and will all try to gesture at some type of good faith, cooperative relationship with the public. They've kind of each expressed their own mea culpa, sorry, we want you to trust us, but let us handle it on the inside with our different kinds of solutions that we're providing. Twitter, in this case, is proposing algorithmic transparency, its own kind of internal watchdog organization, bringing in more people, more experts who can spot propaganda and disinformation, for example. But I think, we should be wary of letting the sector, and these three companies in particular, set the terms of the debate. I mean, I really think it's not appropriate for them to come in and tell Congress what the terms of the debate should be. And so, we're hopeful that members are going to be prepared to ask the very tough questions.
Now, the kinds of content we're talking about is so vast. There's misinformation, disinformation. Obviously, we've been really focusing on misinformation and disinformation around COVID and the election. Then there is the proliferation of online hate. The Anti-Defamation League released a new study today pointing out that 41% of those surveyed have been victims of online harassment. 27% experiencing severe harassment, so sexual harassment, stalking, physical threats. Folks in the LGBTQ community reporting the highest rates of overall harassment, and a huge surge in harassment against Asian Americans, which is not surprising given the violence against Asian Americans we've been seeing in the broader community. Most of this abuse occurring on Facebook, then followed by Twitter, Instagram, which is of course owned by Facebook, and YouTube. I know this is the focus of your work, but what's your response to that?
It's undeniable that Facebook has played a significant role in the spread of racist propaganda that is also an incitement to violence against Asian and Asian American communities. And of course, my heart goes out being, Black American and part of a community that is also subject to racist violence in our country. And I think what we want to remember is that the scale and the speed to which Facebook and Twitter can amplify, and Alphabet with its product YouTube can spread harmful, incitements to violence is a very, very serious issue. But I don't think it's just limited to that. We also have, for example, Facebook implicated in discriminatory practices, precluding job and housing advertisements to be equally shared, right? I mean, we know these kind of like civil rights violations, fair housing violations. I mean, it's a much more complex ecosystem here than just hate speech. And I want to make sure we keep the lens wide here on the kinds of ways that so many organizations, news organizations, civil society organizations are really forced to engage with Facebook if they want to have reach into the public. And one of the things that I always try to remind regulators and policymakers is that we cannot just regulate these tech companies and simultaneously defund every possible democratic institutional counterweight to these types of organizations, which means we can't defund education, higher education, public media, public health, public libraries. I mean, those are also really important knowledge and information resources that are struggling in our society. So we need to keep the lens wide here on what's happening. And of course, we condemn hate speech and the way in which Facebook allows its platform to be used to organize, violent militias and mobs and individual actors who exact, crime against our communities.
Now, I want to zero in on what Dorsey said, that removing content isn't necessarily a good solution, though, of course, Twitter has booted Trump from the platform permanently, and Facebook has done so indefinitely, but that decision is now going to the Facebook Oversight Board to decide whether he will be banned permanently. You have been named to the unofficial Facebook Oversight Board. Do you think we need to see more removal of content on a large scale, or is that not the answer?
Well, content is one of these industry words that's invented to flatten and make it real difficult to understand what we're talking about. And so what people think is that we're talking about, commentary or free speech. But let's be reminded that content, the way that we think about it in the tech sector, also includes incitement to violence. It includes non-consensual pornographic sexual material. And I've been very proud to be part of the Cyber Civil Rights Initiative that has helped bring about laws on the books in 48 states around the removal of non-consensual pornography, or what we kind of colloquially think of as revenge porn. That's also part of the content. Bullying, defamatory, dangerous, reputation destroying information and content also has to circulate through these spaces, and it really gets flattened when the platforms say, we can't manage all the content. Well, some of the content has real life or death consequences, and life impacting consequence. And I'm not sure that it's okay for them to disavow their responsibility for that.
Sophia, we could talk about this for hours, days.
Couldn't we?
Thank you so much for helping us distill some very complicated topics. And of course, we'll be following the hearings tomorrow. Sophia Noble, Associate Professor at UCLA. Thanks so much. Coming up, single women are leaving Silicon Valley and other tech hubs in droves. We're going to look at why the exodus, what cities they're going to now. That's next. This is Bloomberg.
Women in the last 30 years were coming out of poverty as a globe, and now we're seeing a huge setback in that arena. We're seeing setback in the labor force. The number of women who've stepped back from the labor force in the United States, 2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
My conversation there with Melinda Gates, where she stated that the pandemic has thrown women into a moment of crisis, though not all news is grim. A recent report out by Redfin finds that single women have seen twice as much growth in home purchases as single men, and home purchases by women are up 9% more homes in the fourth quarter compared to a year ago. The hottest markets for single women looking to take out a mortgage: Boston, Providence, and Detroit. But they're not buying homes in tech-heavy cities like San Francisco and San Jose. Joining me now for more, Redfin chief economist Daryl Fairweather. Daryl, women are buying more homes, you say. Then we hear Melinda Gates say women are in a moment of crisis. What is the disconnect?
The economy is just so unequal right now. The people who were able to buy homes before the pandemic started, for the most part, are still able to buy homes, especially if they've kept their jobs, if they work in a tech-heavy field where they're working remotely. Now is really the time to buy because they're working from home and they want more space. And women are included in that. They are taking advantage of low mortgage rates and buying up homes.
So they're going to Detroit, Providence, Boston. They're leaving San Francisco and San Jose. Why?
Well, San Francisco, San Jose, to begin with, already had a really low share of women buying homes. The industry there, it's tech heavy, it's software heavy, and those tend to be male dominated fields. So the people who earn the most money there tend to be men, and they're the ones buying homes. In a place like Boston, though, it's more biotech focused, more medicine focused. And there are a lot of high earning women, single women, who buy homes there.
So does this have something to do with Silicon Valley maybe being a little bit of a brotopia?
I think that is exactly right. And I think there are a lot of people, women included, who only really live there because of the job opportunities. And with remote work, it's opening up all new opportunities for places to buy homes. Some women are looking to the suburbs to get more space, and some women are leaving the Bay Area altogether, going to Sacramento that's more affordable, or going to Austin, Phoenix, some of these other secondary tech hubs.
Now, looking at the real estate market more broadly, there is record low inventory, and you actually say this is a horrible time to buy a home. Why is that?
Well, it's really tough out there for buyers. You might be facing multiple offers. We've heard stories of buyers coming up against 12 other offers and the home going for $100,000 over listing price. And that is really upsetting if you're a first-time home buyer just trying to get your first home. If you're putting less than 20% down, it's going to be really tough. People with all cash are really winning right now, and experienced buyers are the ones that are winning.
Now, I'd love for you to share a little bit of your personal story because you lived in Seattle, where Redfin is based. You've now moved to Wisconsin, where I assume you can buy a lot more with less. You thought it was temporary. It's become permanent. I wonder how many people out there are really like you, and if we're going to see a fundamental population redistribution, or if things will drift back to the way they were, which is congregating in cities over time.
Yeah, so my story, I think a lot of people are going through this. I was one of the people who was able to keep my job through the pandemic. I actually had a baby at the beginning of the pandemic, so I was on maternity leave for the first half, and then I came back to work, was working from home, and I really liked it. And, you know, with a young baby, and I also have a toddler, I really wanted to be close to family. So me and my family, we moved out to Wisconsin, which is where my in-laws are, and we're living in this lake town, the beautiful resort area. So I get to enjoy, you know, the beautiful scenery and be close to family, and I'm working from home and get to spend more time with my family. So it's really a win-win for me. I know other people, they are struggling through this pandemic, but we found a way to kind of make it work and make the best out of this really strange situation.
And yet, with folks going back to the office, the demand, the pressure to feel like you have to return to the office is going to start creeping up on people. I know people are already feeling it. And so I wonder, do you think we're going to see a fundamental population redistribution or not? Ultimately, are folks going to return to the cities in droves as fast as they left?
I think there's going to be a split. There's going to be a bifurcation. Some people who want to work remotely, especially if they're in an in-demand field, will be able to continue. If not with their current employer, there are plenty of job openings right now in tech-heavy sectors for remote workers. So if you want to work remotely, you'll probably be able to keep doing it. And there'll be some offices that really want people to be in the office, and there's some people who prefer that. So they'll sort into those jobs. I don't think it's going to be one or the other, but I do think remote work will be a larger portion of how people work going forward.
All right, Daryl Fairweather, Redfin's chief economist. Thanks so much, Daryl, joining us from Wisconsin today and for sharing your story with us. Okay, coming up, Tencent feeling the heat as Beijing continues its tech crackdown. We're going to take a look at the Chinese giant's rise and what's to come for the company next. This is Bloomberg. Shares of car makers moving on the back of concerns about a worsening shortage of chips for cars. Car makers like Tesla, NIO, GM, Ford, all down amidst an expanding shortage of chips for automakers, and U.S. automakers extending production cuts as a result will continue to follow. Meantime, Tencent, ADRs, or American Depository Receipts, trading lower after the company reported quarterly revenue that barely met expectations. Uncertainty remaining around what a Beijing crackdown on tech companies means for Tencent, which of course has many different kinds of businesses. Bloomberg's David Ingles took a look at Tencent's rise and what is next.
Tencent is China's most valuable company, with over 2.3 billion accounts registered across all of its platforms. To understand how it got here, a quick glance at its past. Founded in 1998, it turned profitable within 3 years, and by its IPO in 2004, had amassed more than 290 million users on its instant messaging service and online games platform. Its biggest turning point, though, was arguably the introduction of mobile messaging app WeChat 10 years ago, which coincided with the explosion of smartphone adoption across the country. This thrust the app literally into the hands of hundreds of millions of Chinese people and took Tencent's monthly active users across all platforms to more than 1.2 billion people. Since listing, shares are up over 80,000% and revenues have grown a staggering 400 times. In the third quarter of 2020, it delivered profits of $6.8 billion on sales of just under $19.5 billion, giving it a profit margin of 35%. Now, all this cash has allowed the company to place bets on many horses, and some don't necessarily align with its core businesses. According to one estimate, Tencent has put over $23 billion into more than 800 companies, 160 of which have reached unicorn status with valuations over $1 billion. And some, Meituan, Pinduoduo, Kuaishou, and Neo, have themselves listed and now command multi-billion-dollar valuations. Together, Tencent-backed companies are currently worth a combined $850 billion. But with Chinese authorities stepping up scrutiny of the internet sector and cracking down on monopolies, it's not clear if the company will still have the same freedom to expand. So what does Tencent's future look like? Well, the company could find itself at another major crossroad. Analysts who cover the stock are still overwhelmingly bullish on the company's future.
Bloomberg's David Ingles there from Hong Kong. And that does it for this edition of Bloomberg Technology. Tomorrow we'll be covering the big tech hearings in Washington. Do not miss our full coverage.